Okay, you just put this on, I guess.
All right. Good. Are we ready?
Yes.
Good. All right. Good afternoon. We are the team from BI Norwegian Business School, and the next 10 minutes will present to you our key research findings and recommendation for Tomra, a company that internationally engages in the industry of machinery and is present on the Oslo Stock Exchange. So, based on our analysis, we get a target share price for 1 year of 114.8 Norwegian crowns, and that represents a 12% downside from the last observed market closing price in February. Therefore, we issue a sell recommendation. So, although Tomra has in the previous years performed well and has added value to its investors, we state that this will not be the case in the forward-going years. So we have calculated that the current market share price is overvalued, and we further support our recommendation of selling with the next facts. So first, there is an overestimated likelihood of Tomra to expand in the new markets. Then they are expanding in a very volatile cyclical industry, and also their current growth is unsustainable. So now let's talk something more about the business Tomra operates in. So Tomra engages in the provision of the sensor-based solutions in two segments, in collection and in sorting. And as we can see from the graph, they have been over the past years increasing their revenues in the sorting. So this is expected to continue and also eventually balance out the collection. Well, this is a little bit problematic. Why? Because, especially recycling and mining, they depend greatly on the commodity prices. And those are, very, very much exposed to cyclicality. And now Ruud will tell you something more about the competitors.
Thank you, Mina. To further reiterate our investment thesis, we looked at Tomra's current competitive scenario. As you can see, Tomra maintains a consolidated market share in the RVM and material recovery segments, which constitute its collection business. However, the markets are more fragmented when it comes to its sorting business due to increased global competition. To reiterate our point in the investment thesis where we said the growth of the markets will not be sustainable, this stems primarily from the collection market. Tomra has recently completed orders in Germany and Sweden for replacements, as well as entered into New South Wales for about 4,500 machines. We believe that the growth that this has represented will not continue into the future, and thus we estimate lower growth rates in the collection markets. Furthermore, we believe a key demand driver for Tomra in the sorting market would be increased regulations, especially from developing countries like China, where they have made their recycling regulations more strict. It is now necessary to export waste into China that needs to be sorted. So this is a potential demand driver. However, there are a lot of businesses that currently operate in this segment, and it will be challenging for Tomra to compete. Now I introduce Toby to talk to you about the markets.
Thank you very much, Rit. On the map behind us, we can see in light blue the markets where they operate in sorting. And on first glance, it really looks like they are well diversified over the globe. But if you actually dig a bit deeper into the revenue shares coming from those different markets, you can see that North America and Europe are actually the biggest contributors in terms of revenue share. Also, the market is somewhat more fragmented than the collection market, and therefore they have less leeway in pricing their products in that regard. In dark blue, you can see the collection markets, and there are only 11 markets they're operating in. However, the markets are very consolidated. That means they have a high market share in those markets, which gives them more leeway into pricing. However, if one of those markets breaks away, that pushes the business significantly down, and it's not unprecedented. The market is reskinned over the last years. For example, the market in Victoria was reskinned in 2008. There are also some potential new markets that might pop up in the future, namely Scotland, some regions in Spain, and Quebec is thinking about expanding their deposit scheme. However, it's very, very difficult to actually implement one of those deposit schemes, and that is due to the fact that the industry is not a big fan of those deposit schemes. That is because the deposit schemes adds to their cost, and the consumers perceive a deposit as a tax. Therefore, they are less likely to buy products. Therefore, in Germany, it took them 11 years to actually implement the law, which is a significantly long time, especially for a country like Germany, because we Germans are actually considered to be very efficient. So yeah, how does that translate into revenues? Over the last 4 years, we've seen a CAGR of 15%, and we don't expect that to move forward over the next 7 years. And that is mainly due to the fact, again, that the new markets are actually hard to implement. There's underestimated market risk. Furthermore, the cyclicality has a higher impact on the Tomra business. As we can see, it is growing significantly over the years, coming from 37% to 42%. So that will put some pressure on the business due to the cyclicality. And now Craig is talking more about the valuation.
Thank you, Toby. To derive our fair price, we have relied purely on the DCF analysis. We have made a projection of free cash flows until the age of 2024. We have calculated a weighted average cost of capital at 7.19% with a cyclically adjusted beta. And we have determined a terminal growth rate of 3%, which is a bit above expected inflation rate and GDP growth rate, and that's mainly because Tomra is highly exporting company. The implied share price that we have arrived at is 114.8. And to further stress test our key assumptions, we have performed a Monte Carlo simulation with 100,000 iterations. The 64% of them have fallen at least 10% below the current market price, which represents a sell.
We have also performed a sensitivity analysis, and we have identified that Tomra's share price is mostly sensitive to the change in the future revenues, the level of interest-bearing debt, and also the terminal growth value. So we have adjusted the models accordingly. In the center, we can see our with DCF obtained target share price, and the red line here, it portrays where the current market share price is surpassed. We argue that this area will not be likely achieved. Why? Mostly because there is an uncertainty in the opening of the new markets, and also because the beta of the company is increasing.
Now, even though we have determined the fair price based solely on the DCF analysis, we have also performed relative valuation with the forward EV/EBITDA metric. And we have seen that it has been trading recently highest among its peers. The historic premium has been 22%. However, the premium right now is over 50%. The implied share price that we have arrived at is 95.4. We have also looked at the forward PE ratio, which historically hasn't been trading without any premium. However, the premium now is almost 40%, and the implied share price is even lower at 88.4. Now Fabian will talk about investment risks.
Thank you. The main investment risks when it comes to collection solutions is the political environment, which is currently really uncertain. Imagine, in a really uncertain political environment, the first priority on a political agenda might not be implementing a new deposit scheme. So that's the main driver here in this section. When it comes to sorting solutions, we experience a competitive landscape that is even increasing to grow in 2018. So the more competition that affects the market share of Tomra, the less likelihood that they can maintain their market share and have stable revenues. To wrap up everything, we think that Tomra is actually a good company, but the expectation for new markets to opening up is not that high actually, because we have seen it is a long and complex process to implement new deposit markets, and there is a high instability in political environment. The other part is the expansion in more volatile cyclical markets through the sorting business. So this is just more competition, and Tomra really needs to make sure they can have their market position maintained. To sum up, I would suggest to sell Tomra shares, even if we think it's a good company, it is a bad investment. Thank you very much for your attention, and we would be open right now for your questions.
Do you maybe want to check on the microphone? It's it's not turned on.
I think this one.
They're streaming, they're streaming actually. So it seems like the other one is a bit louder.
Check.
Are you guys ready?
All right, let's kick off. Mick, do you want to start?
You're very clear on your revenue estimates, but you don't really mention anything about your EBITDA margins or anything else from the profit and loss statement. What do you see happening to the margins?
Yes, can you put up the slide, please? Yeah, you can see that the margins are actually quite strong. They're stronger for the collection business because there we have a sales market. Their revenue share is also very dependent on service, which is a more margin, which has higher margins in general, and therefore they have very strong margins in that regard. For the sorting business, it's somewhat lower the margins because they have more competition in those markets, which puts a bit of more pressure under those margins. But in general, you can say that the margin development is quite good.
And quite stable.
Quite stable, yes.
When you do your relative valuation or multiple comparisons with peers, what kind of companies have you been comparing Tomra with?
Yeah. So this is the peer group that we have constructed, and we believe the peers aren't truly comparable. That's why we also we have based the DCF, the price purely on the DCF. As we can see, we have only one public company, the public peer in the collection business. We have also seen Envipco, but Envipco's margins were all over the place, so we have excluded that from the valuation. And the sorting peers are somewhat spread out among different segments, and they are not actually competing with Tomra in all the three segments in the sorting industry.
Last one for me then. You point to high risk due to commodity prices and cyclical industries. How much of Tomra's revenue share comes from cyclical end markets?
Well, currently it is around 30%, but we do believe that this will continue to increase. That's why we have also adjusted a bit beta in that regard.
All right, thank you.
Yeah. Could you just flip to the very last page of your appendix? Just wanted to ask some questions to your DCF valuation. Yeah, I think it's a... Yeah, here. I'm just interested about the terminal year there. So can you explain what's happening to working capital first?
Yeah, the working capital is very, so the change in working capital in 2017 is very high. We have spotted that pattern due to the potential new markets openings, and this has happened in the past. The stack up of inventories has happened, and we have modeled the ratio of inventories to cost of goods sold accordingly to the historical evidence.
And 2024, that's the free cash flow you use as a basis for your terminal year?
Yeah, yeah.
Because then what is the big difference between CapEx and D&A there? Where does that come from? Because it seems like if you combine the difference between the CapEx and D&A and then the working capital, then you have a 500 million headwind in your terminal year, which would make an absolutely massive impact on your terminal value.
Can you...
Yeah, so...
I didn't understand the question.
The CapEx there, how do you relate CapEx to D&A? How do you think about that? What's growth CapEx and what's maintenance CapEx?
Well, going forward, there is mainly the growth capex due to expansion in the new markets.
Yeah.
And so among the PP&E of Tomra, we have predicted that the share of, for example, buildings and stuff has been going down going forward because of the growth
Great.
expansion.
All right. Have you thought about what are the product cycles and the customer cycles and maybe, you know, how long do these products last? I don't know if there's a difference between the two segments. Can you talk about that? And perhaps additionally link that to your growth thoughts.
Yes, for collection, for example, there is a product cycle of 9 years. We can see that, for example, if you look at Germany, the initial placement of machines was around 2005, and the replacement took 9 years later in 2015. So this is the average life cycle of a collection machine. For the sorting segment, I would argue that it's somewhat lower, because they are more heavily used than collection systems. And therefore, they have a life cycle, I'd say, around 7 years. And you can see that pattern in the replacement. Yes, and linked to growth, I mean, of course, if you replace machinery more often, you have a higher growth rate. And that is also reflected in our DCF, where we have a growth rate of 10% for sorting and 8% for collection.
Until the terminal.
Until the terminal, yes.
Thank you for your presentation. Just a quick question here. Why do you think the share price is where it is today? You know, what's the market discounting, or what's the market seeing that you don't?
Well, they are most probably overestimating the likelihood of expansion to new markets. And they might have gotten a bit overexcited from the replacement in Germany of the machines that increased the Tomra's revenue, and also in Sweden that took place quite recently. So we do say that one key driver here is the market is just overestimating the likelihood of expansion.
And how, in your mind, you know, what's the likelihood of Tomra managing to expand?
Yes, I mean, there we also have to look at the different segments again. For collection, for example, it's very unlikely. As I said before in the presentation, opening a new market is a very difficult business. There are changing majorities in the political landscape. There are industries lobbying against it very strongly, so that is very difficult. And especially, as Fabian pointed out, the political landscape looks not very good at the moment across the world. For sorting, it's somewhat more likely that they expand because there is a higher food safety awareness, for example, in emerging markets like China and India, which will facilitate their business in a way.
And on the collection side, I mean, I don't think even I as an oil analyst have to admit that, you know, there's a bit of a green wave across the Western world and parts of the emerging markets. And, you know, it will have an impact on both collecting and sorting. Now, of course, you know, politicians being politicians, they will listen to the public. So despite the politicians being difficult, do you think it's, you know, likely that they will actually listen to the public and do implement, you know, some ways to counter all the plastic pollution to get more plastic recycling? Is that so unlikely?
I mean, I don't say it's not going to happen at all, but I mean, it's very difficult. It's a long process. It's a difficult process, and we still have a high growth rate for collection. It's 8%. That's something many companies can't achieve.
Mm-hmm. And yeah, you mentioned the green wave, which is part of the expectations that are quite high, which are included right now in the share price, as we think. And actually, if you really dig deep into what kind of materials can be efficiently recycled, because we, for example, have a downcycling, a recycling, and an upcycling, which is different. For example, with plastic bottle, with PET, how it's called in many countries, there you have the real recycling, which it kind of makes sense to recycle this kind of plastic. But with many different other materials, there is no chance that you can achieve a or even an upcycling. So basically you, in many countries, you sort the glass for different colors. I don't even know if that's done here. But in general, after that is separated, you put everything together and use it in 98% of the cases for something completely different. That's why it is really limited on how much you can actually recycle. And due to that fact, there will be studies that could show, for example, from normal political lobbyists, it is in many cases not worth it and efficient to have such an implementation. And that's why it's not that likely that Tomra even can more expand in that section.
Maybe one final question. In your forecast period, you show that Tomra is very cash generative. What if Tomra did a lot more acquisitions? They've done a lot in the past. How would that affect your target price and your conclusion?
Actually, in our conclusion, it's already included that they will have to further acquire companies in the sorting business to maintain their competitive position, because it is a really competitive environment. And when we look at collection business, then they're not even allowed to acquire further companies, because that's due to the regulations and due to competitive law. So there they already have such a huge, large market share that just the competitive and institutions would intervene, that's for sure. Thank you.